Hello everyone, welcome to Get Skilled with Disha. Today we will go a little deeper in understanding why we do financial modeling and what results it gives us. If you are new to my channel and want to know how can you get job after college and you don't know what should you learn, please watch my previous video which tells you how this one skill can make you employable and clear all your doubts. And before we start building an actual financial model in Excel, I'll first help you understand what kind of problems a financial model actually helps us solve. So let's start with a simple example. Imagine a company wants to invest in three solar power projects, but the company has three different projects to choose from: Project A, Project B, and Project C. Now comes a question: which project should the company invest in? And more importantly, should the company invest at all? Just looking at these three solar plants, we can't really answer that question. We need to understand things like how much money we will have to invest, how much revenue can the project generate, what will be our costs, how much cash will the project generate over time, what kind of return can we expect, and what happens if our assumptions don't go as planned. This is the problem that financial modeling helps us solve. So, rather than making a decision based on intuition, we want to use numbers to save these questions. Now, let's see what the financial model would actually help us understand. The first question that we want to answer is whether the project is financially viable. In very simple words, does this project make financial sense? To answer this, our financial model calculates several measures. You can see three of them here, like there is NPV, there is IRR, and there is payback period. Now, if you have never heard these terms before, don't worry. You don't need to understand the calculations right now. For now, just understand what we are trying to find out. For example, this table tells us that the project has an NPV of 1245 million. It also shows an IRR of 14.8% and a payback period of 6.2 years. These are different ways of looking at the financial attractiveness of the project. Think of it this way: NPV helps us understand the value created by the project. IRR helps us understand the project's return in percentage terms. And payback period tells us roughly how long will it take to recover our investment. And based on the assumptions used in this example, the model says the project is viable or not. So the financial model is helping us move from I think the project looks good to here is what the numbers are telling us. But there is another important question: where is this money actually coming from and where is it going? That's where cash flows comes in. Now let's look at the project's cash flows. This is actually quite easy to understand. Money comes into the project and money goes out of the project. The money coming in could be revenue from selling electricity, and the money going out could be operating costs and the initial investment. Whenever you build a project, you will invest some amount, right? And then your project will get started. And then for running the operations of that project, you will incur some costs. That's how finally you will generate some revenue out of the business. Now, look at year 0. Here we have an outflow of 500 million. Why? Because before the project starts generating electricity, we have to invest money to build the project. Then from year 1 onwards, the project starts generating cash. For example, in year 1, we have cash coming in of 120 million and cash going out is 50 million. So our net cash flow is 70 million positive. So we earned revenues, we made expenses, and finally the cash flow at the end of the year is 70 million. And the same calculation happens year after year. Year 2 gives us a positive cash flow. Year 3 gives us even higher cash flow, and so on. The chart at the bottom shows the cumulative cash flow. It helps us see how the project's cash position changes over time. So, when we talk about financial modeling, we are essentially trying to understand the complete flow of money throughout the project life, from initial investment to the cash generated over the years. But there is a problem. These numbers are based on some assumptions, and assumptions can change over time. Let's say we built our financial model and everything looks good. Can we simply just make the investment? Not yet. Because our financial model is based on assumptions. What if the electricity tariff is lower than what we expected? So we expected a base case around 5 rupees per kilowatt hour. But what if it gets reduced by 10%? Or what if it gets increased by 10%? In all three cases, there will be different revenue generated and different impact on NPV. So the final NPV values are changing. Similarly, what if operating costs increase? What if interest rate goes up? Or what if the solar plant generate less electricity than expected? These are some of the key risks shown here: tariff, operating cost, interest rate, and generation risk. So now we ask another simple question: what happens to our project if one of these assumptions change? This is called sensitivity analysis. As one assumption changes, our NPV value also changes. And this chart here helps us quickly see which variable have the biggest impact on the project's NPV. As you can clearly see, if generation changes, our NPV changes by a higher amount than rest of other variables. So, financial modeling does not just help us understand what could happen, it also helps us understand what could go wrong. Now, let's say the company has three projects that all look potentially attractive. How do we decide which one to choose? And we are back to original question. The financial model allows us to put projects side by side. We can compare how much each project requires us to invest. We can compare the NPV. We can compare the IRRs. We can also look at how quickly we recover our investment. And we can also look at other measures such as benefit cost ratio. In this example, project A has the highest NPV. As you can see here, 1245 million among all these three projects. It also has the shortest payback period of 6.2 years. That means the money is getting recovered in just a time span of 6.2 years. And for the other projects, it is taking much longer to get back the money. So based on these financial measures, project A appears to be most attractive option. But remember, financial model does not simply tell us choose the project. It gives decision makers the information they need to make the decision. We would also consider risks, uncertainties, and other business factors before making the final investment decision. So the whole purpose is to compare the alternatives and understand which option can potentially create the most value while keeping the risks manageable. So let's go back to our original problem. We started the three solar projects and one simple question: which project should we invest in? Financial modeling helps us break that big question into smaller questions. First, is the project financially viable? Second, what cash flows and returns can we expect? Third, what happens if our assumptions change? And finally, how does this project compare with our alternatives? That's the basic idea behind financial modeling. In this video, I wanted you to understand the problem financial modeling is trying to solve. We haven't gone into the Excel formulas yet. and that's intentional. In the upcoming videos, we will take each of these concepts and understand them from the very beginning, starting with concepts like cash flows, net present value, IRR, payback period, and many more. So if you are completely new to financial modeling, don't worry. We'll build it step by step. So, if you want to understand these concepts in detail, stay tuned to my channel. Don't forget to like and subscribe the channel Get Skilled with Disha and stay tuned. Thank you.